Hi, my name is Craig Alexander, and welcome to the quarterly economic forecast update. As we're heading into 2020, it's natural to ask what is ahead for the coming year. And the main themes are we're expecting to see a continuation of economic growth, perhaps improving a little bit over the course of 2020, both for the global economy and for the Canadian economy. We expect interest rates to remain relatively low and stable, and for the Canadian dollar, we expect it to fluctuate around where it's been at around 75.5 cents over the course of the year, probably trading in a range of a cent, cent and a half around that average number. While those make for good business planning assumptions, businesses do need to be mindful that we continue to be in an elevated political risk environment. In point of fact, we live in a world where populism and nationalism is being felt around the world. And while we appear to have diminished the most acute risks, the political environment is going to continue to be one where we're no longer having policies pushing towards more open markets and more market-friendly policies. And this creates political risks that's going to be with us for the foreseeable future. In terms of the details of the forecast, let's look at what's going on in the global economy. So in 2019, the global economy slowed quite sharply, and there was a concern throughout the year that we could see a turn in the global business cycle and that a recession could take hold. In point of fact, what we actually saw happen was the manufacturing sector globally went into a contraction, but weakness in manufacturing did not feed through to services enough to actually cause a turn in the business cycle. So ultimately, global economic growth dropped from 4% last year to around 3% this year. When we look ahead, we think that the global economy is showing signs of stabilization. The manufacturing contraction seems to have abated. Global trade is no longer contracting like it was. And as a consequence, we think that the global economy will strengthen a bit as we go forward. However, I would stress that what we're looking for is modest improvement. We're not going to get back up to that robust 4% growth mark. We do think that we will see some of the headwinds abating, but we don't expect a dramatic shift in global behavior. The big risks to the global economy that we were focused on in 2019 was the uncertainty related to Brexit and also the US-China trade war. An escalation and a bad outcome on either front posed a material threat to the global economy. A hard Brexit could have pushed Europe into a recession. The US-China trade war was threatening global manufacturing. What actually transpired was that while we lived in a very elevated political risk environment throughout 2019, it appears that the most acute risks have actually diminished. In the wake of the UK election, it now looks like a soft Brexit is the most likely scenario, and that is the one priced into markets. In terms of the US-China trade war, by the end of the year, we actually saw some improvement in terms of cooling. The issue hasn't gone away, but it's not accelerating, and there has been some progress in terms of US-China trade talks heading into 2020. So as a consequence, while the political risks have not disappeared, and political risks continue to be the leading risks to the global economic outlook, the most acute downside risks have diminished. One of the most interesting things that happened in global financial markets last year was the remarkable strength in equities. And I think this is one of the core messages from a business point of view. When we were heading into 2019, we had the worst equity market correction in a December on record. Markets were absolutely convinced that 2019 was going to be a recession year. But if you were an investor that sold in December and went away for the entire year, you actually missed one of the best years in equity markets with a close to 20% gain in North American equities. The message here for businesses is the same. One of the things we've been stressing is that yes, there are recession risks out there. Yes, we are late in the business cycle, but you cannot let the risks paralyze you, and financial markets don't always get it right. In point of fact, businesses that didn't over-respond to the recession talk actually probably found opportunities to seize in 2019 because the worst case scenario did not in fact transpire and financial markets were wrong. When we think about the Canadian economic outlook, the Canadian economy has had a lot of volatility in its economic data. It was very soft heading into 2019 and in early 2019. Then we had a very strong second quarter growth of 3.5%. In the third quarter, growth again cooled. It went down to 1.3%. But if you look at the volatility and you average it out, it appears to us that the Canadian economy is probably tracking to an average gain of 1.7% in 2019. And that is in line with its long-term sustainable rate of economic growth. In 2020, we think that we'll see a mild improvement. We think that economic growth will pick up slightly to around 1.9%, but we're not expecting to break the 2% mark. So this is going to continue to represent a modest rate of growth. When we think about the components, we're expecting to see consumer spending being supported by rising wages, high levels of employment, relatively low unemployment. The thing holding back the consumer is going to be the high level of household debt. Real estate is contributing to the economy. It's benefiting from lower mortgage rates that came because of lower global bond yields. We also are seeing the real estate markets improving because the prior tightening in mortgage regulations are having less impact. The areas where we're seeing headwinds on the Canadian economy has been, number one, on the export front, caused by the slowdown in the global economy and weakness in Canadian manufacturing, which actually has been more resilient than many of its international counterparts. But through global supply chains, manufacturing has softened. The other area that we've seen weakness has been business investment, although the third quarter actually showed us some strong investment gains. The question is whether that's going to be maintained. I think business investment is a bit of a wild card in the forecast because there might have been pent-up investment that has been delayed because of uncertainty like the renegotiation of NAFTA. But now that we've had a ratification of the new trade deal, that uncertainty has diminished and it could trigger an upside risk to business investment. Nevertheless, business investment has been a serial disappointment in recent years, and so we're using very conservative numbers in our forecast. We'll believe a pickup in business investment when we actually see it. So when you put the components together, the pace of economic growth in Canada is going to be modest to moderate. When we think about the provincial outlook and we look across the country, you will get different stories depending on where you are. The Ontario economy is expected to deliver relatively solid gain around its long-term trend rate of 1.8%. The Quebec economy is poised to slow, dropping to about a 1.5% pace. But keep in mind that Quebec has been a top performer in recent years and is experiencing acute labor shortages, and this is going to restrain growth in Quebec. The BC economy is a similar sort of story as Quebec. After years of strength, the BC economy is moderating. One of the provinces that has suffered the most in recent years has been Alberta. We were tracking only a slim gain of 0.5% in Alberta in 2019. And we're expecting to see it pick up to about 1.5%. Now, many people will argue, where is that coming from? Because they still see a lot of challenges in the oil and gas sector. The key thing to keep in mind, though, is that economies have an idling speed. The idling speed for Alberta is that it should grow at around 2% based on population growth and labor productivity. Anything less than that means that you're exerting more negative influence on the Alberta economy. So if the negatives become slightly less pronounced, even though the economy is still facing challenges relative in terms of the energy sector, as long as the negatives become less pronounced, the pace of growth actually accelerates. And this is indeed what we're expecting to see transpire. We're also expecting to see improvements in Saskatchewan, Manitoba, and in parts of Atlantic Canada. But overall, what the general trend is that economic growth across the provinces is going to be sub 2%. In line with the underlying story for the national economy. So when we think about the global, Canadian and provincial outlook and we put it all together, what's the core message? The core message is that from a business point of view, for planning purposes, assume modest economic growth improving slightly, low and stable interest rates with the Bank of Canada leaving rates unchanged, a currency fluctuating around a central point of around 75.5 cents. Those are what I would put in a business plan. But I would seriously suggest that businesses think about the risks and contingencies. I think that businesses need to think about scenarios and how their business will be impacted by a future turn in the business cycle. It's now been 10 years of economic expansion since the last recovery and the recession of 08-09. So when we think about the economic outlook, eventually we're going to see a turn in the cycle. Typically business cycles are 8 to 10 years long. this business cycle is long in the tooth. Now, it can run longer than normal. It can run for several more years, but at some point there's going to be a trigger that will cause a turn in the global business cycle or the Canadian business cycle. And businesses need to think about how they would manage their businesses through the valley of a recession. I would also argue that we are living in a very difficult political environment. In decades prior to the 08-09 recession, we were in a world where politics were moving towards more open markets, more global markets, more ease in movement of goods and services, less regulations or barriers or restrictions on trade. I think the world has fundamentally changed. I think the rise of populism and nationalism has led to a pushback against globalization that is not complete. I think even if the US-China trade war does not accelerate, we're not going back to the pro-market, pro-globalization world that we had before, regardless of who wins the 2020 US presidential election. Meanwhile, in Europe, the UK is actually the most pro-market economy government in Europe, and with the UK leaving the EU, their voice is no longer going to be heard at the EU table. So as a result, we are going to be living in a different political world that poses greater risks to businesses, and they need to think about what the implications of that new world means to them. So with that, I hope that this has been a good summary and overview. If you have any questions, please reach out. Always pleased to answer questions that clients or Deloitte members have. If you want to get more information, please read the forecast. So just click on the link below or go to Deloitte.ca. Thank you very much.